Alright, so interest rate increases are finally here, and so of course is inflation, and I want to share with you the perfect magic trick to describe exactly what has happened this week. Just want to make sure you see both sides of this bill, because this is going to look like camera trickery, it's going to look like video editing, but I promise if you were here with me in real life, you'd see exactly this. So I just want to make sure you see all the angles from the front and the back, because in 3, 2, 1, this bill starts to look a lot like a $100 bill, which is exactly how inflation works. No, it doesn't. It does, but in reverse. Now, just as that happened, my friend and I were out and about, the rates went up, and he was like, great, now it's gonna be that much more expensive to buy a house. But then I told him the federal fund rate went up by 0.25%. And the federal fund rate does not directly affect mortgage loan rates as much as people think. It affects different things that I want to talk about in this video. Also, another little interesting tidbit you might not have known about is the S&P 500, the stock market, has historically gone up in the first 12 months of rate increases, which kind of goes against common sense, and it begs the question, what else does this affect? How does this affect student loans, credit cards, mortgage loans, auto loans, interest rates on savings accounts, interest rates on crypto accounts? So in today's video, I want to share with you exactly how this will affect us, how this is going to affect the markets, but most importantly, how it's going to affect our financial lives. So let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the magic. And if you press the J button on your keyboard to go back 10 seconds to watch that trick again, you'll notice you still have no idea how it was done. The magic of inflation. So the first question I had is, why did the stock market go up if rates also went up? Because whenever interest rates go up, it's supposed to have a cooling effect on the economy. So why did the opposite happen? And it happened because the stock market is what's called forward-looking. It's always trying to make a prediction about the future. And right now, the stock market predicted 7 rate increases. So the second question is, where did it make this prediction? And I was not notified. Where do I find this information? And you can find it here in what's called the dot plot, which is directly from the Federal Reserve. Each dot is supposed to represent a member of the FOMC, the Federal Open Market Committee, and their guess for what interest rates will look like. Now, you can see the median falls somewhere around 1.75%. So if you take that number and divide it by 0.25%, you get 7. 7 rate increases, and that's how the stock market was able to price that in. Whenever a prediction is made though, and if that prediction happens to be true, it validates the information, and it's like a magician. It's like, I knew it, and the stock market sometimes goes up. Other times, if interest rates, for example, were higher than 0.25%, the stock market would have gone down, and that's how it knew. Now, according to LPL Financial, when interest rates go up, the stock market has typically gone up in the first 12 months. The last 8 times when rates started to go up, the S&P 500 was up higher than it was the year before. So here's exactly which stocks did the best from each sector. Stocks in the tech sector did by far and away the best at 20.6%. At number 2 was real estate at 12%. Number 3 was energy stocks at 11.9%. Then healthcare, 9.7%. Then utilities, 8.3%, and the S&P 500 at 7.8%. Now, those were the 6 best sectors. There's 6 more, but they just didn't do as well. Now, the reason that tech stocks do the best is because anytime there's worries of inflation, the time value of money decreases the value of future cash flow in how we value those tech stocks. And when we increase the interest rate, which is a way of fighting inflation, that's when tech stocks recover. So tech stocks fall the hardest because of inflation, and they recover the hardest because we're fighting against inflation. That makes sense. Now, the second question you might have is, if inflation is 7%, then how does increasing the rate by only 0.25% going to do anything to help fight inflation? In the 1970s, when inflation was running at 12%, Paul Volcker, which was their Papa Pal at the time, increased the federal fund rate to 13% to bring down demand. So then, how does increasing the federal fund rate now by 0.25% going to do anything to help us? And the answer is, it probably won't. But also remember that we're going to have 6 more federal fund rate increases throughout the next 6 Fed meetings, 3 of which should happen this year and another 3, maybe 4 next year. And that should bring us up, but also be prepared for that scary news cycle that's going to happen. Now, the reason that we're increasing the rates so slowly is because we have to, otherwise we risk going into a recession. There is a time to increase those rates fast, but not in a time where inflation is high. when everything is becoming more expensive, because then you risk creating more unemployment where people lose their wages and their jobs. And then you create what's called stagflation, which is not the place we want to be. So that's what happened this week. Now let's talk about how this will all affect us personally with something called the prime rate. All right, so there's the federal fund rate and the prime rate. Here's the difference. It gets heavy, doc, so I don't blame you if you fall asleep for this next part. The federal fund rate is, remember, the interest rate at which banks borrow money from other banks to meet what's called the overnight reserve requirements. You see, banks lend us money, but they can't lend all the money because when we go to withdraw the money, they need to have the money, which is why they need to have some minimum in relation to how much they lend out. That is the law. Now, sometimes they'll have more than they need, other times they'll have less than they need. Now, if they have less money than they need, then they need to borrow that money from somewhere. And that somewhere is usually one of two places, either from each other, like US Bank borrows from Chase, Chase lends to Wells Fargo, or they could borrow money from their regional Federal Reserve Bank. This is called the discount window or the discount rate. This is usually a lower interest rate, and these regional banks offer different kinds of loan structures, and one of them is based on something called that prime rate, and that's the one that affects us the most. If you're still confused, think of the federal fund rate as the interest rate for big banks and lending institutions to borrow money, and think of the prime rate as the interest rate for consumer-grade products, things like credit cards and HELOCs. Now, let me tie all this together because this next part is the most interesting part. The Federal Reserve cannot change the prime rate. They can change the federal fund rate, but not the prime rate, which on Wednesday went from 3.25 to 3.5%. So how did it change, and why are my rates not this magically deliciously low for things like my auto loans, student loans, home loans, credit cards? What gives? This is because this decision of the prime rate is left completely up to the commercial banks. That's why we can go to one bank and apply for a credit card and go to a completely different bank and apply for the same credit card but get completely different interest rates, because that decision is left completely up to them. But here's something even more interesting. Even though it costs the banks 0.5% to borrow money, they're not going to allow us to borrow that same money at that same rate. They're going to charge whatever the federal fund rate is plus typically 3%. That's what makes the prime rate. And it sounds really greedy, but it's actually based on one simple decision, and it's because of bonds. Think about it like this. If you were able to make a guaranteed return of 2% on your money and your friends came up to you and asked to borrow that money, would you lend it out to them for less than that? Maybe you would because you're a good friend and you don't care about money, but most people probably wouldn't. And this is because if you're gonna risk your money right now, you're not gonna risk it for less than what you can guarantee yourself right now. And that's why mortgage interest rates are not determined by the federal fund rate. They're not determined by the prime rate. They're determined by the yields in the bond market, the place where you, me, banks can all make a guaranteed return on our money. So instead, mortgage rates will actually start going up when the Fed will start to sell their bonds, which they said they would do at their next Fed meeting. Because when the Fed starts to sell off the bonds, their prices fall, but their yields go up. And that's when all these lending institutions and banks will look at the bond market and they'll say, look at these shiny new bonds that the Fed just flooded the market with and all these higher interest rates. You know, if I'm gonna risk it for the biscuit and start lending my money, I better make sure that my loan rates are higher than what I can guarantee myself a return on right here in the bond market. If you've fallen asleep at this point, I don't blame you. This stuff is so complicated, but if you haven't, you're amazing and you're a nerd. And I love it. So now let's talk about how this will affect us when we go to borrow money for other things. Bottom line, this will affect people that are going to borrow money in the future and people whose loans right now are not fixed, like an adjustable rate mortgage. Now, for student loans, remember your payments are not going to start until May. And when they do, remember that if your loan is from the government, if it's a federal loan, your loan has a fixed rate. That will not change. But for new student loans, that will change in July. Those loans are set by the government, and what the government looks at is what's called the 10-year Treasury bond yield. So whatever that yield will be in July is what's going to be the interest rate for new student loans in July. If your student loan is from a private lender, those do track the federal fund rate that just recently got increased. If your payment is fixed, there's no changes. Otherwise, it will for new borrowers. Now, when it comes to any kind of revolving credit, things like car loans or credit cards, that'll be more expensive by at least 0.25%. But how much depends on exactly what we're talking about. If we're talking about credit cards, right now, there's roughly $807 billion worth of outstanding credit card debt. Each American family, on average, owes something like $6,270 of credit card debt. So if you're somebody who carries a balance month to month, which you should never do, you should always pay off your credit cards on time and in full, then expect to pay more money within 1 to 2 statement cycles. Now, if you want to take out a car loan, it'll cost you a little bit more. How much more depends on your credit worthiness, but expect to pay probably a little bit more than 0.25%. Personally, I think it's kind of silly that some people are paying over 20% on their credit cards, especially when they realize that some of these companies took out that money at 0.5% interest. It'll be interesting to see how crypto disrupts them, but let me share with you exactly who benefits from all this. Crypto. I'm just kidding. Crypto interest rates on deposits are not determined by the federal fund rate or the prime rate, so they're probably not going to change much because Bitcoin and crypto does not depend on the traditional banking system. Instead, it's based on the price action of Bitcoin. Because if Bitcoin's going up and everyone's excited, they want to take more risk, they'll want to borrow more Bitcoin, and that's when rates go up. And the opposite is true. If Bitcoin's going sideways or going down, that's when interest rates fall because nobody wants to borrow Bitcoin, so interest rates fall to make it more appealing to borrow more. That's kind of how it works. The only exception to that is maybe rates go up if crypto companies want to compete with banks and savings accounts, but the truth is they really don't have to because savings accounts are yielding very little. But they're about to yield a little bit more, as much as theoretically 0.25% more, but it depends up to those companies if they want to increase it, and sometimes it takes weeks, if not months, before we see those higher yields. And isn't that funny? When it comes to paying a higher interest rate on our debt, that comes fast. When it comes to paying higher gas prices, those go up fast. But when oil falls just like it has, gas prices still have not. And when it comes to passing on those higher yield benefits, those are going to take a long time. But when it comes time to collect, they're like, what's up? Now, unfortunately, there's gonna be 7 more rate increases, again, anywhere between 1.75 to 2%, and even if the prime rate reaches 3% on top of that to 5%, and savings accounts yield even more, I still believe that inflation could eat away at our purchasing power and our dollars. Which is why now more than ever, I'm still staying invested in the markets. I'm not pulling my money out and waiting on the sidelines, and I think that's the most important thing. And if you're a homeowner, think about refinancing now before rates go up, and if you're not, think about buying soon before they go even higher. # not financial advice. As always, don't forget to have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin with this link right here. Free stocks, links down below. Go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I will see you back here on Monday and Friday, sometimes Wednesday. Bye-bye.